All right, so welcome back to Multifamily Live. I'm Jason Yarusi, and we are very excited to bring you this webinar recording that we taped just last week about an upcoming project with better way to learn about multifamily investing, to just hear from us about what we're doing. So here's an offering. This is a 506C opportunity, meaning it is for accredited investors only. However, this gives you the overview of the two properties that we are under contract to acquire in the next 60 days here in Murphysboro, Tennessee. So dive in, take a listen, enjoy. The properties are 165 units. They're right down the street from other properties we currently own, and we're welcoming to bring you this opportunity today. If you are interested to learn more about investing with us, feel free to go over to yarusiholdings.com. You can come over here to Seven Figure Multifamily. We can point you in the right direction to talk to us, to learn more about these opportunities, understand what we do here, and see if it's the right fit for you in your investment journey. Also, if you want to learn more just about investing overall in multifamily, make sure you go there. Go to Seven Figure Multifamily, learn what we're doing, ask some great questions. We welcome you and love you having you here with us today. So dive in, enjoy the webinar. Let's do this.
Hello, everyone. Welcome. I'm going to give everybody a minute. Just jump in. How are you all tonight? There is a chat and a Q&A for you guys for tonight. So it's going to be about a 30-minute conversation about a couple apartment buildings we have coming up. And then if you have any questions, you can drop them in the Q&A. So welcome. We'll give everybody maybe just like a minute or two to jump in here. Everybody's kind of piling in. And we'll kick off our presentation on the Dempsey and the cottages here in Murphysboro, Tennessee. So if you guys are in the chat, there's some options. It says host and panelists. So you'll be chatting to us as hosts and panelists. There'll be the four of us that you guys see on. And then the Q&A, if you guys have a question, it's best to put in that Q&A because then I can track it. I can make sure I get it answered. We'll give it like one more minute and then we'll kick it off. Welcome, everyone. I am excited for this. We've been working on this deal for a while. An awesome team, awesome deal in a great place just outside of Nashville, Tennessee. So we're excited to share this tonight. I see a bunch of people that have invested with me in the past. Welcome. Happy to have you guys back. What's up, Adam? Hope you're doing well. Gerald, hello. Ken, Luis, hello. Scott, Troy. What's up, Troy? Tim. Good to see you guys. A bunch of military guys that I know on the call. It's great. All right, you guys ready? Jason, Chad, Peely, you guys ready to go? Cool.
Ready to go.
We'll kick it off. I'm sure some more people will jump in. If you're just joining us, welcome. There is a Q&A down at the bottom of your screen there. You can drop in some questions as we go. We'll probably save the questions till the end. We'll go through. It'll be about 30 minutes or so, maybe a little less, give or take, on the presentation. And then we'll do 15 or 20 minutes of questions. We'll get you out of here inside of an hour. So if you guys have some questions, just drop them in the Q&A. And then there's also a chat feature that you can chat to us as hosts and panelists there. So we're going to kick off a presentation about a couple of apartments that we have here in just outside Nashville, Tennessee and Murphysboro. It's 165 units total, two buildings called the Dempsey and the Cottages. I am going to go through the introduction. I'll introduce the four of us, and then we'll go through a lot of the numbers and data and why we like this deal so much. Most of you have been on a webinar or a call of ours before. If you're watching this recording or you're jumping on for the first time, we'll go through about 30 minutes and then ask any questions. Then we'll be available after this if you have any further questions. So we're going to go through the team. We'll go through executive summary, some investment highlights, overview on the properties themselves, and then a bunch of financials. A lot of these financials you're going to see are a bit of an eye chart. We'll talk to it a little bit, but we want to put them in here so that way afterwards, if you want to dive in, if you're a detailed person, you're an engineer like me or Tim, who's on the call that I know, you guys will be able to go through it afterwards in more detail. I'm going to pass it around to my team. Jason, if you want to kick it off, you can tell people how awesome you are.
Sure. All right. So welcome. Really excited to be here tonight. My name is Jason Yarusi, a partner with my wife, Peely here. Excited to partner with Bill and Chad on another great project we have here. I'm a real estate syndicator and investor. Live here in Murphysboro, Tennessee. I've done about 27 transactions, with about 24 of them being multifamily acquisitions since 2016. It comes to about 2,300 units in 7 states. Totals about $245 million in real estate. Main focus are properties just like this. basically go in there, look for properties here where we can get economies of scale, a lot of things we're going to talk to tonight, and really focus to put our tried and true plan in place. Of those 27 acquisitions, we've now had 13 that have run the full business plan out, all the way full cycle to an exit. I also host the Multifamily Live podcast with my wife, Peely, and also have the Seven Figure Multifamily here with Jason, with Bill, Chad, and Peely. All right, I'll let Peely dive in now as well.
Aloha, everyone. I am so happy to be talking with you tonight. These properties are amazing. So I run the investor and client relations branches of both Yarusi Holdings and Multifamily Live. And Multifamily Live is our interactive platform that we have with Chad and Bill. It's an incredible platform that we have. And I am also, like Jason said, I'm the co-host of Multifamily Live with him. It's a podcast where we get to share our expertise, our knowledge, and a lot of really great stories about our journey within multifamily real estate and beyond. And above and beyond, we have 3 awesome children, Luke, Lily, and Leo, about 13 chickens, and our English bulldog, Jill. So again, thank you for being here.
My name is Bill Allen. I run a company called Blackjack Real Estate, another company called Seven Figure Flipping. We launched a software company recently, do multifamily with Chad, Jason, and Peely, and flew in the Navy for 20 years. I retired in June. I've written books. I'm working on a kids platform right now, a bunch of things that I like to do. I've flipped over 1,000 houses in my career, and now partnering with Jason, Peely, and Chad, doing multifamily. We've done, I've done everything from building brand new construction storage units down in Orlando to all the deals that Jason, Chad, Peely, and I have done together over the past 4 or 5 years. I'm primarily responsible for investor relations, dealing with the capital raising, figuring out how to finance these deals, and signing on debt. So I'm happy that you guys are here with us. Pretty much every deal that I've done except for one have been with this group that's here with us, Jason, Peely, and Chad. And I pretty much don't like to do deals outside of working with these guys. I think they're the best operators in the business, and I'm really happy to be partnering with them. So we, like they said, we do an investor training platform called Seven Figure Multifamily and Multifamily Live, which I really enjoy. They are the brains behind that and run that group, and they get to train the other people that are out there raising money and doing deals out in the marketplace. So I don't think there's anybody better to invest and operate a building than these guys. So
awesome. Hey, everybody. My name is Chad. I own Titan Capital Group. I started my career in sales at Xerox door to door, and then I got into real estate. Had the pleasure of working with Bill Allen to flip a portion of those 1,000 homes that he flipped. I was a small portion of those, working with him for a while, and then branched out into commercial real estate, and told Bill, I was like, hey, we gotta put the gas pedal to the metal on this commercial real estate thing. That was a few years ago now, and we've taken 9 properties full cycle, total of 18 properties down, 82 million in current assets under management with a total of 715 units. So very excited to be here with you guys and dive into the details on the deal. So this is 165 unit. It's 2 properties. One is 64 units. Another one is 101 units. It is in a submarket outside of Nashville called Murphysboro, Tennessee. Jason, Peely, myself, my wife, and our families all live in Murphysboro. These deals are in our backyard. We're able to keep a close eye on them. The other reason that is a huge benefit is because this puts us at 290 units total in Murphysboro. That doesn't even include our Nashville holdings or the holdings we have in Mount Juliet and some of the other places around Nashville. But just in Murphysboro submarket, that puts us at 290 units. Jason, when he gets into the financials, will share some of the benefits of that regarding payroll, contract services, some of the economies of scale we get with our laundry contracts, our cable contracts, and things that allow us to drive the expenses down in order to drive the NOI up and force appreciation on the building. We all understand the only way to force appreciation is to either raise rents or decrease expenses. In a time like this, where the market is where we are, crazy rent growth and rent assumption bumps are not what we're planning on getting. So really, you have to find ways to drive net operating income through operational efficiencies. So these buildings are less than a couple miles from both of our headquartered offices. You're welcome to come down, check out these buildings and the offices as well. The reason I really, really like this deal is because the average rental price point is something that I believe in a recession everybody can afford. I don't think the C+, B- renter class is going anywhere. I think the $1,200 price point, the $1,100 or $1,200 price point is going to be a place where you will have steady occupancy. I don't like the Class A stuff, the $2,800, $3,000 a month in rent. I think that goes away and when market economics get tight. So I think this is a great win-win project for investors that are looking for long-term stability and they're looking to mitigate against some of the volatile markets like the stock market, the Dow Jones, the SPY. We're all tired of riding that roller coaster. So this is a great project for some stability in your portfolio. We're also doing a cost segregation study, which we'll talk about to get some depreciation and losses passed through to you guys for calendar year 2023. And yeah, we're going to talk about a lot of other things. Some of the investment highlights at a very high level, we'll go deep into this, but the equity multiple is 2.15 on an average annual return of 16.15 with an internal rate of return of 13.72. This project is targeted at a 5-year hold. Purchase price across the two properties is $24 million, bringing us to a little over $140 a door. Funny enough, we have a property about 300 yards away, and we just appraised for $165 a door about 6 months ago on that project. So we believe we're getting a solid price. The other benefit of this, having 290 units in the market, is when we do look to exit, having a portfolio of 290 allows us to go after a little bit bigger fish for the sale and get a blended higher average price per door across when we do look to exit in this thing in 5 to 7. We have a capital improvement budget in there. Year built is 84 and 85. So nice 80s product. The construction's great. When you come walk these units or come visit the property, you'll notice that they've been really, really well taken care of. Current occupancy is at 96%. We are extending an opportunity to invest in the Dempsey Cottages LLC. And that asset will be purchasing both of these properties. The member preferred return is going to be at 7% with a 60% member ownership split going to the investment portfolio. So why we love this deal, just real highlights. This is a 506C syndication opened for all accredited investors. PPM available is going to be on 11/3. We're targeting to have those PPMs signed by November 17th. Funding deadline is going to be 12/8, and we are pushing for that 12/21 close date in order to hit this calendar year. So a couple of the highlights, I talked through a lot of these things, but economies of scale with our local portfolio, stabilized assets with operational efficiency opportunities. I've done a lot of deals with Jason. I've done a lot of deals with Bill. I can honestly say that I don't think there's anybody better that I've met in the business, and I've met a lot that understand how to cut costs without sacrificing quality better than Jason does and Peely. And they know how to run an asset of the highest caliber while also maintaining very, very low operational costs. And we'll talk about our property. Peely's going to talk about our property manager here at the end and how they're going to assist in us being able to do that. The other thing that we love is we are purchasing the entity. So if anybody's familiar with an LLC or entity purchase, what that does is it mitigates our transfer taxes. It actually eliminates our transfer taxes on the purchase, which is a 6-figure number. And then what it does on an annual basis is because we're buying the LLCs that own these assets and we're not doing the straight real estate purchase, it eliminates the assessment that would have increased our taxes over $200,000 more annually than if we purchase the entities. I can go into that a little bit more in the Q&A if you guys have questions, but it puts about 170 to 200,000 to the bottom line in years 2 through 5 because we're purchasing the entities. This is in a great area in Murphysboro. As I mentioned, Murphysboro was named the 3rd largest growing city in the United States. So it's doing pretty well. I don't think the population demographic is going anywhere but up in this submarket, and we're seeing it as boots on the ground. Cost seg here in 2023, and as I mentioned, we are just a couple miles away from both of our headquarters. Jason?
All right, so let's dive in. This is a property overview. As said, this is two different properties. Each are about 1 mile each from one side of us to the other side of us, but it does put us in a place here we can get the economies of scale across the portfolio by adding these properties here. So this is the Dempsey. It's 101 units built in 1984. It's comprised of 6 buildings, 1 site, has 63 one-bed units and 38 two-bed units. Amenities are a dog park, barbecue pit, laundry facility, fire pit, playground, and a pool. The current buyers had brought these 2 assets as part of a 5-property portfolio. The other 3 properties are not here in Murphysboro, or actually up towards the Nashville area here. So at this time, as part of their purchase, they have to disperse a couple of properties, and these are 2 of them that need to move outside of our portfolio. So we feel that we're getting a very, very good purchase price on these assets. Chad did mention here that we have another property that appraised about $20,000 more per purchase unit just recently. And there's also another property here that we know in town that's being purchased at a quite considerable purchase price hike compared to these properties. This is the Cottages at Bear Branch. The great thing about this property, it's actually a neighbor property to another property managed by the management company that we utilize here in town. That property is doing tremendous. This property is going to be really be able to capitalize on having the next door neighbor property for bringing in new leases, new tenants, and everything under the sun there. 64 units built in 1985. This comprised of 11 buildings, 1 site, 42 one-bed, 10 studios, and 12 two-beds. Has a dog park, a laundry facility, and a garden courtyard. Financial analysis here. We had talked a bit on this here. The investor IRR going into this is going to be 13.73 for the course of the project right here. I know we talked a little bit on this before, that the investor equity multiple is going to be 2.15, with the total investor equity invested and requested per part of this raise is 9.6 million. We will look to have this on a 5-year horizon. We're going to match that with the debt here we have with a 7-year expectation for which our business plan will run. This sizes very well with the other properties we have here in town. One of the most exciting things about these projects is that it gives us the ability to maximize on the other business plans, to utilize those across these business plans as well. Chad, let's kick it to the next slide. This will get emailed after. So don't fear that you're going to have to dive into all these right here just on this call. But please, some of the really big things here that are going to be some of the things that we can really get back is that we're going to have shared leasing and maintenance across our properties. This asset class really fits that we can utilize one office space to be able to maximize on getting the marketing done and servicing all this property. So it's going to help us really pull back on our payroll costs across the properties. That same thing is going to carry forward for our contracts, right? Everything from landscaping to pest control to other parts we're going to utilize across properties. With the leverage of having max properties here in town and also the number of units that the management company has, we also get very discounted rates to be able to put in affordable things with laundry contracts, and cable contracts will give us another income drivers on the properties. Beyond this, we talked about the savings that we have across the board for marketing going out of the main office, which will really help us. We have a tremendous amount of energy that comes into MMC, which is our management company, through their marketing for rentals. And so for this, it's going to put us in a great spot to have a number of different units. Our other comparable properties here in town are mainly 2 bedrooms. So this gives us a nice advantage to be able to push forward, to have another offering, to make sure we're maximizing experience, to be able to have a great unit when someone comes in to rent. 2 options here. The Dempsey, that is 101 unit. We're going to look at an agency loan, a Freddie Mac loan. It is a 5-year loan amortized over 30 years with 1 year of interest only period. The standard here is that we will look to have a loan to value of 65%. And that's going to be a great property here to be able to use this loan to give us the best interest rate coming into this. The cottages, based on the size of it, we have chosen to go a bank route. This is a bank we've worked with 2 other times here. They have a great loan. It's a 5-year, 25-year amortization here, has a 1-year interest only period. However, the buyout is very easy. So if the market changes and interest rates are lower, we will be able to capitalize on that and moving out of this loan in a considerable fashion, or even package these loans in the future as we increase value to be able to go and refinance and do a cash out of equity here for this loan as well. It does have a higher interest rate going into this at a 7.85%. This does trend. If we see rates lower as we go forward to a closing, that will also work into our favor here, as that also plays in the loan we will get here. All right.
Yep. And I want to just say one thing before I get off this slide is when we talk about the advantages of having the portfolio, especially when it comes to being able to exit, when I say exit, I mean a capital event like a refinance or a sale. The other properties that we have, the other 130 units that are within a few miles of these, they also have a minimum of at least 5 years left on their debt as well. We were able to get there's 6 years left on another one and almost 7 years left on the 902. So there's ample time for a 5-year hold to be able to make a decision with the portfolio, which would allow us to have some significant upside for that time frame in 60 months from now. Here are some rental comps for the data folks that are in this webinar. Like Jason said on the financial page, I'm not going to go through each one of these, but feel free to look at the rental price point where we're at and the price per square foot. Based on the comps, you can see some of the similar ages here. And then we also like to really dig into the fees and what the tenants are paying, because sometimes you'll see a comp and maybe that comp looks really high, but they're including, certain amenity fees or things like that in it. So we really look at our effective rents. And that's what I care about, is what is the net rent that's coming to our bottom line, less everything else, because that tells me what I'm able to charge our tenants. So we're in a very good spot when it comes to our effective rents based on where the market is driving. You can see the proximity to the units here. And I think the fees and the couple of the properties I don't believe are being captured on the operational efficiencies and some of those fees. MMC is one of the most professional management companies out there. So we're going to be able to recapture a lot of this lost income here. And then also we're in just a really solid price per square foot for our rental rates. So feel free to dive into those. Here are some of more of the rent statistics, some of the year built, other unit counts, and the square footages and the average rental price points per month. So feel free to dive into those. I don't want to bore you with too many details. Also the sales comps. So what's important is obviously the price per unit. We're at a blended 145 a door, like 144 a door on our purchase price on these assets. So some of this stuff is a little bit newer, but you can see with our 80s vintage, a lot of this stuff is trending well over 200 door, somewhere even 300 a door on the newer product. So we're in a very good spot. A lot of the 90s vintage is in the high 160s. Like I said, we just appraised for 165 a door just down the street. So being a blended 144 a door on our purchase is putting us in a really good spot. And I'll kick it over to Peely to talk about the market.
Aloha, everyone. So this is the market overview of Murphysboro and Nashville, Tennessee. This was the one-time state capital of Tennessee. Murphysboro of today is still a thriving city. And like Chad said, it's the 3rd most growing city in the United States. So we are growing, and we're growing at a very rapid pace. With only a 40-minute drive to Nashville, residents of Murphysboro can enjoy visiting the big city and easily return home to the suburban comforts of the borough. And despite its proximity to Nashville, Murphysboro actually has everything you need. I'm not going to read this entire thing, but basically what we're trying to tell you is Murphysboro, because of growth, because of rental growth, and because of its proximity to Nashville here, we have so much going for us in this market. Apartment rents in Murphysboro are still rising as one of the fastest paces in the metro, while Murphysboro typically experiences moderate sales activities, improving demand drivers, and an increase in recently built assets have attracted institutional buyers to this area. Like Chad was saying, in about 5 to 6 years, when we're looking at the exit for this property, we will be able to package it in such a way. Sales volume has already outperformed the submarket's historical average this year, thanks to the sale of a recently built asset. While only a handful of transactions take place each year, unit pricing continues to trend upwards. So Murphysboro is still trending upwards. The number of rental occupied households has increased by more than 10% over the past 5 years, coinciding with the growing number of 20 to 34-year-olds in the submarket. The increase in this age cohort has driven much of the submarket's population growth, which ranks among the top in the pack for submarkets in Nashville. Since more than 80% of students live off campus, these seasonal renters have a sizable impact on the market size apartment demand here. Additionally, the number of households making more than $75,000 has increased by roughly 60% within that same period, perhaps illustrating that a portion of these students are choosing to remain in the area after graduation. Murphysboro is amazing. Next slide. Property management team. I cannot say more amazing things about our property management team. So we are using MMC management and marketing concepts. We are proud to partner on this deal with MMC. They're locally based in Murphysboro, Tennessee, and can currently support many of our properties in this area. In fact, I would say they have a high percentage of that 290 units that we have in Murphysboro alone. They are currently focused on the Middle Tennessee area, specifically Rutherford County, where we all live. So their understanding of the market is unparalleled among competitors. They conduct professional resident screenings that will assist in reducing our liability for damages, evictions, and legal costs. Their experience locally will work to your advantage. They provide maintenance workers that are not only skilled, but are licensed and paid hourly. Their commitment to excellent service is much higher than that of third-party contract workers. So I want to stress that because of the amount of units that we have in Murphysboro, because of the amount of units that we use with MMC, we're going to be able to share the expenses, thereby raising the NOI. And also, these properties are also less than 2 miles from our offices. So we are right here. We live here, we work here, we love it here. So these are some of the properties that we have in Murphysboro. We have the Metro. So once you're able to go through this, please read through some of the buildings that we currently have with this property management team. The Metro, which is a 32-unit apartment community located again in our backyard. The 902, again in our backyard, is this concrete fortress of value. And then the Bransford on Berry. This is another property that is in Nashville, but is also managed by MMC.
Awesome. Yeah, they're great.
They're outstanding.
Investment disclaimer. I'll let you guys read through this. Obviously, we are not Nostradamus. We cannot predict the market, as none of us can. I mentioned this in the very beginning. I can get on this webinar and truly tell you guys that I don't believe that there's a better asset class for your capital than commercial real estate. I literally 90% of all of my money is in commercial real estate. I think it's the greatest hedge we have against what may be on the horizon. And I think that, I believe that the market is going to come back by 2028. And when I say come back, I mean interest rates are going to come back into a bullish, 5% environment. And I think that's when we're going to be able to strike on a refinance or a sale in order to maximize returns for everybody. So that's what we're projecting. Obviously, we have our own capital in all of these deals. Every deal that you just saw, we have our own capital in these things. We are right here with you guys as investors as well as operators. This is all we do full time. Jason and Peely, myself, I talk to Jason 6-7 times a day. They're very brief conversations, but they're always about our deals that we're currently working on. We're in the weeds looking at properties. I think the important thing for you guys to understand is how many deals that we look at that we say no to before we actually get on here and bring you guys one. We look at hundreds and hundreds of deals. I'm on airplanes. Jason's on airplanes. We're driving around all the time, walking units, tens of thousands of units we've walked. And we're very selective about which ones we decide to pull the trigger on. I don't pick up the phone and call Bill unless we feel very confident about one. And we look at a lot of them and say no. We say no to probably 99% of the stuff that comes across our desk, if not more. So I just want you to know this deal's been hand selected, and I believe in the asset class long term. And it's a great place to get those tax benefits in year 1 and year 2. And it's a great place to get the quarterly distributions when we stabilize out. And I just can't think of a better spot. So if you're tired of riding the roller coaster of the different markets that you may be in, get yourself into some commercial real estate. Even if you're already in, I'd recommend doubling down right now, because I think housing is going to survive anything that is coming. Appendix, if you guys need a little update on your definitions. And that is it. We like to keep it short and sweet. Get your questions answered if you have them. I'll bring back on Bill to sort of run a little bit of a Q&A. If we missed anything, please let us know. Our contact info is down there for everybody as well. I think
if you guys could drop some questions in the Q&A, it'd be very helpful. And then if you guys are not, if you're just ready to go, you love it, send me an email. So the next step, we are still uploading this deal into our InvestNext platform. So, but right now, bill@blackjackre.com is right down there. You can send me an email. You can include the whole team if you want, but definitely get it to me and I'll lock in your spot. So you just can send me a couple things. So, and Peely, if you don't mind dropping this in the chat for everyone, make sure it says to everyone. So if you can put your name in there, the amount that you want me to set aside for you. So how much are you going to do a soft commitment for? And then how are you funding that deal? If it's personal money or if it's IRA, 401k money. And if it's IRA and 401k money, if you already have it with a custodian or if you need to do some work to do that. So speed at which that you can fund the investment. So if you have to set up an account and all those kind of things, that's something we can give some referrals to and set you up and help you out. Okay. Somebody dropped a lot of questions in here. So I'm going to throw them out to you guys. And the rest of the group, if you have some questions, just drop them in the Q&A or in the chat. I'll monitor both. So first question is, what risks and challenges do you guys see with these 2 buildings? So what concerns do you have about this deal specifically?
Jason, you're muted.
Oh. Ideally, right, we're facing a lot of challenges out there in the market, but one of the greatest things here about Murphysboro is there's so many things that are driving people to this market, right? So the risk would be that we go in there and try to push our business plan forward and have a hard time filling units at the desired rental rates. However, looking at the comparable properties and the energy on our other properties, the driving forces bringing people to Murphysboro, the large employment base and the employment diversity, it puts us in a great place to mitigate any risk that come across from a leasing perspective. Other past pack there is that we're not able to capitalize in the best way on being able to share maintenance and share leasing across the property. So if that were to happen and we had to bring on extra staff, that would eliminate or lower our ability to cut down on our payroll and other pieces of that part. Next piece from there is that contracts, labor continue to drive through the roof in terms of cost and cost allocation here, that continues to drive up into the market right there. Those would be some of the major concerns on that part, is that we're not able to capitalize on the current business plan as intended here. However, we are already having our other properties perform at a very tremendous rate here. So being able to capitalize on that ideally is making sure that we have the right staff and the right team on board to be able to maximize on the business plan.
Yeah. I mean, I would say we walked every unit. Jason and I, Peely was there too. We walked every single one of these things. I don't think there's nothing at this property that's going to come out and bite us. I think Jason hit the nail on the head. It's simply like, just assuming the market and the economics of what's going on in the marketplace is like our only risk and challenge with a 5-year horizon on this thing. That's about all as I see it. The concerns that I have for the property with MMC managing it are very minimal for the property itself. I think from an occupancy standpoint, we're going to stay pretty full based on that rental price point spiel that I gave in the beginning. And then with a management company like MMC, we're tracking pretty well on the financials. I understand what Jason's saying, but I think we should be good there. You want me to hit those other questions too, Bill, or you want to?
Yeah, before you do, the biggest thing that I want to point out to everybody that's on the call is what you see is the deal that we bring to the table after a lot of due diligence and underwriting, to the point where we are looking at every single negative aspect, every single contingency, all the what ifs. And what you don't see is the 100 deals or 200 or 300 deals that have to be shot down before you see this one. So this is not like we think it's going to be good. It's like we're putting our money, our time, our energy, our namesake on the line. So for Jason and Chad to come on and say, these are the things that we think could be an issue, that's going to be an issue for every single property that we buy, period. All the time. That's an issue for a single family house that you own. It's an issue for anything. So I feel like we're kind of splitting hairs there. So if you're on the call and you're like, wow, it sounds like they have some concerns here, it's the fact that we run everything through a massive stress test, and you don't see the hundreds of deals that are laying on the cutting room floor. I don't even see those deals. Like when I see some of these, we're ready to raise capital. I look through the lens that you do as an investor. I try to shoot some holes in the business plan, and we stress test these things to the max. So I just want to point that out, because a lot of times there's always something that could be an issue with these. Then there's never going to be 100% risk-free investment. So, and I don't think there's a team that's probably coming up with secondary and tertiary contingency plans on a regular basis like this. Yeah.
And honestly, if I could just add one more thing, like I look at a lot of deals as well as an LP investor, and I get targeted on some deals that have, some 22, 24% IRR things. Like, just be very careful with those. If you're looking at a lot of deals to invest in right now, if you have a lot of capital, like make sure you know who those operators are. And just, if they're promising 22, 24% IRRs, you really better dig in. I mean, just be careful with where you're putting your money, and make sure you're focusing on the operators and what they've done and what they're doing currently, and make sure this is their main thing.
Hey, Chad, before we hit these next ones, I want to go to Deanna's question. It's she said, this is our first time investing. Can you give me an example return? For instance, if we invested $200,000. So Deanna, in that pro forma there, you saw a $100,000 investment. I think it's a 2.15 multiple. So you would see 115,000. So in your case, all said and done, when we sell the property, you'd see $230,000 of the 200 coming back. So your 200 principal back, and basically 2.15 time multiple of your investment if our plan runs out exactly as planned. And so you can run that right here. This is a hypothetical $100,000 investment. And so you can see how that looks and how it runs through. So you have $51,000 in projected cash flow. So about half of what you invested. So over those 7 years, you would see about $103,700 plus or minus, based on my math. And then the capital event coming back with that extra $63,000. So your $100,000 and the $63K. So all combined, you're at about $115,000 for a $100,000 investment over 7 years. So hopefully that makes sense. And if you have further questions, Deanna, but you can look at each year of what's projected on cash flow and see what kind of returns you can expect on 100,000. And then you can do a multiple of that. So if you invest 500,000, you multiply it by 5.
So let's try other questions here.
Yeah,
how many and how soon will larger mechanicals need to be replaced? On the Dempsey, 4, so not mechanicals, but roofs. 4 of the 6 roofs have been replaced. The other 2 are in very good condition. Of the cottages, all of the roofs have been replaced here. So parking lots, roofs, siding, brickwork, landing, stairs, all in tremendous condition. We did a full deep dive on this. We had the sewer lines scoped out there. We had someone come out and assess the roof here. Someone come out and assess trees. We actually have one tree that the seller is going to take down on our behalf because that was a potential risk. They have turned about 60%, meaning the sellers have gone in there and renovated about 60% of units on each property to some form. With that, they have changed out ACs and done upgrades on the mechanicals, including water heaters. So that puts us in a very good position where we can go in there and tend to the other 40% as we go through these units. But none of them, when walking all these units, were up to life cycle. They have been changed out in the last 5 years or less. We're in a very good spot to walk into this property, not have major needs of day one needs, where we can put a lot of attention into focusing on the renovation plan to get the desired rents. The units that they have turned to 60%, they've done that throughout the course of their hold, so they haven't been able to maximize on rent. So even those units that have been renovated, we still have lost the lease, meaning we can go back into those units either at renewal or at release to be able to capture on a higher rental rate that now serves the market. That said, we do not have downward pressure from a tremendous amount of new construction that's going to meet the need to fill this gap. This is workforce housing. Biggest driver here in Murphysboro is the need for workforce housing. You do see some new construction coming online. However, it's nothing like you're seeing in Nashville. It does not pose any immediate stress or any immediate threat to our property portfolio. The units themselves stand alone. Even standing here in my office today, we had 4 people coming in looking to be able to lease rental units. We're not even leasing out of this office. So there's a quite demand for workforce housing, and there's not the available units. You're going to continue to see this. You're not going to be able to have anything that's going to meet this product, be able to come into the market and create that stress for us on the other side.
Yeah. And there was actually a building moratorium in Murphysboro for the last 3 years on garden style apartment multifamily buildings. So there's no inventory that's coming online. And Jason mentioned in Davidson County, where Nashville sits, there is quite a bit of units that are getting dumped into the market. And those units are at a price point well over $2,000 a month, which is actually putting downward pressure like south towards us. And we're seeing those people are taking a 30 to 40 minute commute to come pay $1,100-$1,200 rather than trying to pay $1,800-$1,900 for a similar size unit, just 30 minutes away. So it's helping us out. So Jason talked about the rehab updates that we'll be completing. Distributions, Jason, you can touch on this, but when we typically take a property down, it does take us at least 1 to 2 quarters to stabilize operations. We want to get a good grasp on our payroll shared expense and our maintenance requests expense across the portfolio. So we will likely be retaining operating capital in the account until we feel like we're very stabilized with our operations. Typically around 6 months timeframe is when we could announce those first distributions for a timeframe for those. So just be prepared for that. It's not like day one, the next month the check's hitting. I mean, give us some time to get everything stabilized out. And then, so we are targeting sale price. We actually had 2 different cap rates, was a 5.75 cap and a 6.5 cap for one of the properties, just based on the different locations of them within the submarket. That kind of speaks to how well we know this Murphysboro market. The cottages at Bear Branch is going to be a 6.5 cap, and then we're exiting a 5.7 cap in 5 years at the Dempsey. So those are our price points when we're targeting to exit. Go ahead, Bill.
So let's answer this next one. Is a 5-year hold or 7-year hold? So based on the financials. So kind of talk to both.
We have this on a 7-year timeline. However, we look at it as a 5-year investment because it allows you to go out there and compare it to other investments that you're seeing out there in the market. Lots gets underwritten to a 5-year hold. We have a 5-year debt on this with the anticipation that we'll be able to get the best rates and terms for the properties today and have the best choice to be able to move out of this as we go. Now, it says 7 years. That's the term of our investments. However, between the 4 of us here of our 20-something full cycle deals, they've all had some hold period between 5 and 7 years, but with the market or getting ahead of our business plan, we've been able to sell them between month 13 all the way up to month 48. So we are looking constantly at how the market's reacting, how we're doing our business plan. So although it's a 7-year horizon, if the market and our asset fits the need, we will capitalize on selling earlier.
Yeah. Or we have, by year 5 too, those prepayment penalties are going to be gone, and we'd be able to refinance this thing, get you all your capital back and hang on to it. If the business plan, we can drive net operating income the way we want to, we can do that as well. So we do believe in 2028, we will be back into a solid interest rate environment. Because if the 5-year or 10-year treasury go the other direction and we're in double-digit interest rates, the last thing you're going to be worried about is your commercial real estate holdings. There will be carnage in the market. So we're very prepared for this is the best investment vehicle you can be in. And then we when rates come down, we're going to be in a good spot to do something.
Okay, so this one, is this property complementary to the others in the portfolio that's close by, or do you see any market cannibalization? And do the multi-property synergies overcome any cannibalization? So is it going to be like bringing more to the marketplace?
So this is going to fit well just because it's such a huge need right now, right? So across the U.S., we need 16 million housing units from 2020 to 2030. Most of that's going to fit into the workforce housing network right now. We're on pace to build about 11 million. So we're about 5 million short. Well, you see that in select markets very heavily across the U.S. Murphysboro is no stranger to that. We need workforce housing. We can't build it. Chad talked to the moratorium here. What they've done here is they've even reduced here in the city of Murphysboro your ability to meet the zoning. So before, if you could build 16 units per acre, now they push that back that if you can and find a place that you can build an affordable faction, well, then it's only 12 units you can build per acre. That said, it's a long process to be able to get a property out of the ground. It's very costly and doesn't make a lot of sense. And if they can get out of the ground, it's Class A new construction. It's very expensive with higher rental rates. Workforce housing, good product like we serve here on our other assets. It's hard to come by. It's very hard to have in place and have available. So it puts us in a great place where we continue to need housing just based on our current assets, where we fill them up as soon as we have them ready with renovations here. These assets will fit the mold very well, just like those.
Another question we have, is the deal currently positive cash flowing? And the answer is yes. Yeah, these properties are, aside from some loss to lease on the rental rates based on what Jason said, and aside from some operational efficiencies allowing us to reduce some expenses, these properties are every bit as stable. This is not a crazy value add, $5 million in CapEx, and I don't really like those plays right now, given the rate environment. So this is a stable project, positive cash flowing currently. Really strong T12 financials. Actually, last month collections went up. Collections went up last month and actually helped us out with our loan and our leverage too. So the property is not only positive cash flowing, but it's the deal's getting better every month too. It's in a really good spot.
Okay, if you, Chad, can you go back to the investment, the potential $100,000 investment? So you kind of look at that that slide that you had. So if you look here, basically what you're looking at is, and for maybe what we can talk to real quick is for some of the folks that are newer to investing in multifamily assets is what does it mean when we're giving a preferred return? And then what happens after that?
So a preferred return is we're doing a 7% preferred return, which means the first 7% of all the free available cash flow is going to you guys. If you look, the question was on $100,000. There's your hypothetical for year one. The cash on cash return projected is going to be around 7%. You can see when the interest only period burns off there, but the 7% is going to be your target average annual cash on cash, with the remainder of those IRR and average annual return metrics being hit by that equity event coming in year 5, whether it's that refinance or that sale. So the 7% preferred return, and then above that is where, once we hit your hurdle metrics for your internal rate of return, that's where then that equity split would kick in, where the 60% of the equity would then go to you and then 40% to us after we've hit those preferred return metrics. So we don't get paid as general partners until we at least hit those thresholds for you to return capital for your money.
Yeah. So the way I like to look at this is we're incentivized to do better than your 7% return. So we make money when you guys make 10, 15, 20% returns. So if you look down, you see a total average annual return of 16.5%. So what I don't want you to think is that you're getting 16.5% every single year. When Chad talked about an equity event, so really the reposition and resale of the asset is what provides that bump from 7%, or potentially we're making more than that. Ideally for us, we want to make more, because when you guys make more, we make money. And then our equity really comes on that cash out, where you're getting that $163,400 for a $100,000 investment. And that's where the bulk of that larger return to hit 16.5% year over year is that liquidity event, that equity build that we built up and added value to the property and sold over time. So hopefully that makes sense, Deanna, and anybody else that's wondering about that. But that preferred return is you guys get paid first, and then we split the equity based on anything that's left over. And I think it's a great structure for you guys as the investors to be able to come in and know that we're on the same team. So the way that this works in very simple structure is we're coming into a business together. These two apartments become a business. We want to cash flow the business. We're going to build it up, make the business more valuable, and sell it. It just happens to be two apartments inside of an entity that we're partners on. We're the general partners. We run the business. You guys bring in the capital and provide the limited partnership that we need to come in. So basically, you're coming in as partners with us. You're the silent partner. We're the active partner. To make it like very simple of how this works.
Yep. You guys will get monthly updates as well. For those who are newer, you get monthly updates. Once we stabilize out in probably year 2, we may move to quarterly updates just so we're not pinging you guys. But in the first year, you'll definitely get a monthly update on how things are going. You can keep an eye on the operations. We welcome you guys to come to Murphysboro and look at the properties. You can give either any one of us, 4 of us, a call and ask any questions that you have about the assets. So we put our phone numbers on there for a reason. We don't give those to a lot of people, but we want you guys to get all your questions answered, feel good about the deal. Like Bill said, we are business partners. I look at these things as marriages. Everybody that comes into this thing is our partner on this. So let us know what you need.
Yeah, the biggest thing I'll share towards the end here is if you're not getting a monthly update from us, something's wrong. It's going to your spam. We have your email address with 1 letter off or something like that. So reach out to us. If you're ever in the dark or feel like we're not communicating to you, it's a mistake. Something's going on. So we're always open. If you have questions, if you need to jump on a call, if you want an email response. The other thing is my son's had 5 open heart surgeries, and we went to Vanderbilt University here, the hospital here, because it was an educational hospital. And so what I realized is they're taking our charts and everything that my son has a very unique kind of chromosome anomaly. And what they do is they're a teaching hospital. So they teach this stuff. And so there's constantly other students that are coming and asking questions. And it's like the best place because they get 40 or 50 people to look at it. So the cool thing that we have here is we have a multifamily mastermind where people come down to Nashville to my office in Spring Hill, which is only about 30 minutes from Murphysboro. And we're walking these units together. They're coming out and they're seeing it. So we're actually showing them the numbers. We're educating them on the deal. We walk these units on a regular basis with them. They get to come in and see it. So we're basically like an educational system using these units here in Murphysboro to do walkthroughs on. They're stress testing them themselves, and we're teaching what we're doing. So I think there's a next level of this that is very different than what a lot of other multifamily syndicators are doing. No one's really looking over their shoulder and putting them in check. And we have really smart people that are coming in on a regular basis to check this out, say, why are you doing this? Giving us ideas. And so some things sometimes we didn't think about to add value is going to come into play when we do some of that stuff. Not only do we have one of the best property managers on the planet that work with us, some of the best syndicators on the planet that are my partners, but we also have students that come in and, when somebody's looking under the hood, you make sure it looks really good before they show up. So there's a few things that are a little bit different about what we do. And hopefully you guys see that and you feel like you're part of the team too. And at any time you can come to our events, come down here and look at the units and all those stuff. It's an open invite to come down and do a walkthrough. And they're all really close together. You can see them all. And hopefully you do an investment with us here, you decide to do a lot more. What I love is half the people on here are already invested with us in other properties. And every time they get money, they're constantly messaging me saying, what do you have? What do you have? What do you have? And just want to go back in and do another deal with us. And I think that's when you're doing a good job. So if there's no other questions, I just want to say thank you to everyone for being here with us. Really appreciate it. Again, if you're ready to invest, just send me an email, bill@blackjackre.com. Let me know your name, how much you want me to hold aside for you. And then if you're going to invest in your personal name or a 401k or IRA. The only thing that we didn't really talk about is that this is a 506c. We mentioned it, but it means you need to be an accredited investor to invest with us. And so, Jason, could you talk to what an accredited investor definition is for them real quick, just so we make sure that we cover that before the end of the call?
So an accredited investor is someone who meets the criteria to make $200,000 as an individual for the past 2 years, or $300,000 as a married couple for the last 2 years, or has a net worth that is over $1 million, not including your personal home. There's a few other things that you can find in the designation there if you're a company having assets over 5 million. So those are the main parameters that would be part. Now, we do not certify you. We can give you other aspects that you can go to certify if you are unclear, right? There's a site called verifyinvestor.com where you can go seek accreditation, or you can have your accountant or your certified financial planner who can come here and give you indication whether or not you are accredited to be able to meet those needs. But that will be part of the language for filling out the paperwork, is that do you meet the accredited investor criteria?
Yeah, and we can support you and help you out and point you in the right direction to get that certification. The other things to think about, a lot of people are like, oh, I don't meet that. Well, think about the value of your business. Think about the value of a lot of the different assets that you have, different things that you have. You'd be shocked. You can actually meet $1 million net worth minus your personal residence fairly easy, especially if you're a business owner. You have some other equity, you have some IRAs, 401ks, annuity accounts, stock accounts, things like that. It's really just assets minus liability. So if you guys need any help or have any questions, you can also reach out to any of us. And so, Brian, yes, this will be available in the 7-Figure Investor portal. And also, I will be emailing out the recording. I will email out the PDF before we get that set up. We'll get it set up in the 7-Figure Multifamily Investor portal as soon as we can. But you guys will have a commitment form, things like that coming from me in text message and email through the CRM that I use. So thanks, guys, for being here. And we'll see you soon. If you guys have any questions, reach out to us. All of our information is there. Hopefully you took a screenshot, and we'll see you soon.